Hello savvy investors, and welcome back to Investor Insights, your trusted source for all things investment and trading. In today's exciting episode, we will dive into trading's complex and dynamic world. Today I'm here to demystify some of the most commonly used trading terms and explain their meanings in a simple, easy-to-understand way. So buckle up for an informative session and don't forget to subscribe to stay updated with our latest insightful videos. First common word in investing and trading is smart money. So what is smart money? The concept of smart money in the stock market refers to investments made by individuals or institutions exceptionally knowledgeable and experienced in financial markets. This group typically includes institutional investors like pension funds, mutual funds, and insurance companies who have access to comprehensive research and advanced analytical tools. It also encompasses legally conducted insider trading. This is where corporate insiders trade their own company's stock based on their deep understanding of the company's internal workings and future prospects. Additionally, hedge funds and investment banks, known for their sophisticated trading strategies and significant market influence, along with experienced individual investors with a long history of success, are often categorized as smart money. Market analysts and financial experts, renowned for their market analysis and predictions, also fall into this category. The actions and decisions of these entities and individuals are closely watched by other investors, as they are presumed to predict and react to market events more effectively than the average investor. However, it's crucial to remember that even smart money investors are not infallible and can make mistakes or misinterpret market conditions. The second common word in trading is time frame. So what is time frame? A time frame refers to the specific duration a trader uses to analyze market trends and base their trading decisions. These time frames can vary widely, from very short to quite long, and are chosen based on a trader's strategy and objectives. Intraday time frames, used by day traders, are the shortest and range from 1 minute to an hour. They focus on capturing small, quick price movements within a trading day. Short-term time frames, ranging from a day to a week, are often utilized by swing traders who aim to profit from market movements over several days. Medium-term time frames, which span from a week to a few months, are chosen by traders looking to capitalize on longer market trends without holding positions for extended periods. Each time frame offers different insights and risks, and traders select them based on their trading style, risk tolerance, and investment goals. The third common word in investing and trading is futures and options. Futures and options are types of financial derivatives that derive their value from an underlying asset, such as stocks, commodities, or market indices. They operate differently. A futures contract is an agreement to buy or sell an asset at a predetermined price at a specific future date. These contracts are standardized in terms of the quantity and quality of the asset, and they're traded on futures exchanges. They are legally binding, meaning both the buyer and seller are obligated to fulfill the contract terms at expiration. Futures are often used to hedge price fluctuations in the underlying asset or for speculative purposes. Options, on the other hand, provide the buyer with the right, but not the obligation, to buy or sell an underlying asset at a specified price, known as the strike price, before or on the option's expiration date. Options are more flexible than futures and are often used for hedges, income generation, or speculative purposes. The buyer of an option pays a premium to the seller for this right. Unlike futures, the buyer's risk is limited to the premium paid, while the seller's risk can be more significant. The fourth common word in investing and trading is hedging. Hedging in trading is a risk management technique used to mitigate potential losses from one investment by taking an opposite position in a related asset. It's akin to an insurance strategy, aimed not at generating profit but at reducing the risk of adverse price movements in an investment. The idea is to offset potential losses in one position with gains in another. For example, an investor holding a stock might buy put options for that stock. These options increase in value if the stock price falls, offsetting the loss. Similarly, a commodity producer might use futures contracts to lock in prices for their product, protecting against market price drops. In essence, hedging involves strategically using instruments like options, futures, and diverse portfolio construction to provide a safety net against market volatility or adverse events. This could lead to financial losses, The fifth common word in investing and trading is index. So what is an index? Index is an statistical tool that represents the collective performance of a selected group of assets. It is typically used as a benchmark to gauge the health or performance of a specific segment of the financial market. Stock market indexes, like the S&P 500 in the United States, the FTSE 100 in the UK, or the Nikkei 225 in Japan, are composed of a set of stocks chosen based on criteria such as market capitalization, industry sector, or geographical location. These indexes provide a snapshot of overall market or sector performance. This helps investors understand market trends and compare individual stocks or portfolios against the broader market. Besides stocks, indexes can also include bonds, commodities, or a mix of asset types. The value of an index changes with the prices of the underlying assets, offering a simplified and aggregated perspective of market movements. It is often used as a reference for creating index funds and exchange-traded funds, ETFs, that aim to replicate these indexes' performance. The sixth common word in investing and trading is spread. So what is spread? The term spread typically refers to the difference between two prices, rates, or yields in financial markets. The most common use of the term is the bid-ask spread, which is the difference between the bid price, the highest price a buyer is willing to pay for an asset, and the ask price, the lowest price a seller is willing to accept. This spread is a crucial indicator of market liquidity and transaction costs. In highly liquid markets, the bid-ask spread is narrower, indicating lower transaction costs and better liquidity. For less liquid assets, the spread is usually wider, reflecting higher transaction costs and lower liquidity. Spreads also exist in other contexts, such as the yield spread in bond markets. This is the difference between the yields of two different bonds, often used to indicate the relative riskiness or expected performance of different debt securities. The concept of spreads is fundamental in trading and investing, as it impacts trading costs and reflects underlying market dynamics. The seventh common word in investing and trading is brokerage. So what is brokerage? Brokerage refers to the service provided by brokerage firms or brokers that facilitates the buying and selling of financial securities, like stocks, bonds, and mutual funds, for investors. These firms act as intermediaries between investors and the securities markets, executing buy and sell orders on their clients' behalf. Brokerages are essential for individual investors to access stock exchanges and other trading platforms, as these venues typically require transactions to be conducted by licensed members. Brokerage firms also provide related services, including investment advice, research, and portfolio management. They charge fees or commissions for their services. These can be structured as a fixed charge per trade, a percentage of the transaction value, or through a fee-based model. Modern trading has seen the rise of online brokerages, which offer streamlined, digital platforms for trading with lower fees, catering to a broader range of investors and making the financial markets more accessible to the general public. Thank you for joining us on this enlightening journey through the world of trading and investing. I hope this episode has helped clarify some of the key concepts and terms essential to understanding financial markets. Remember, knowledge is the most valuable asset in trading and investing, and staying informed is crucial to success. Don't forget to subscribe to Investor Insights for more valuable tips, analysis, and expert views. Until next time, keep analyzing, stay informed, and may your investments be prosperous.